So this is the sum of Feb March 22, paper 32. Okay.
Yeah.
Can you please read the sum for me?
Yeah. Y Limited produces one product. Budgeted units produced and sold for the month of July were 1,000. Further budgeted information for July was also available.
Okay,
Sales
stop. Can you tell me the budgeted number of units?
1,000.
Okay, so your budgeted number of units is 1,000. That means this is your budgeted quantity.
Yeah.
Your master budget will be prepared on what basis?
The standard cost multiplied by standard quantity.
On which quantity? So standard quantity is how much?
The 1,000.
1,000. So your master budget will be prepared on 1,000 units.
Yeah.
Okay, go ahead.
Okay. The sales are $250,000. Direct material $12 per kilo is $60,000. Direct labor $25 per labor hour is $100,000.
Okay, so
Fixed
this is
over
the budgeted information that is given to you.
Yeah.
Then
Then the fixed overhead is $24,000 and the budgeted profit is $66,000.
this is given to, this is the master budget that is given to you.
Hmm.
Okay, go ahead.
Fixed overhead is to be absorbed on the basis of direct labor hours.
What does this mean?
That you need to find out the OAR using
For
direct
the
labor hours.
OAR, your budgeted activity level would be the direct labor hours.
Yeah.
It means this that when you're calculating overhead absorption rate, your budgeted activity level is direct labor hours, and your
Hmm.
budgeted overheads will be what?
Budgeted overheads will be what 1 minute $100,000.
Darling, fixed
So
overhead
24,000.
budgeted overheads is 24,000. If in case you need to calculate any fixed overhead expenditure variance, your OAR would be 24 and budgeted activity level is over here. Are you with
Yeah.
me?
Yep.
Okay, fine. Go ahead.
The actual units produced and sold for July were 1,120. This is actual.
Yeah, this is actual. So if
Yeah.
master budget is given to you, maybe you are asked to prepare an actual budget or maybe you are asked to prepare a flexed budget.
Hmm.
What have they asked you to prepare?
Flexed budget.
So in the flex budget, what do you do?
So in the flex budget, you need to calculate the this. 1 second.
Flex budget is made for the actual quantity.
Yeah, the actual quantity, but it's given now, miss.
Actual quantity is 1120
Yeah.
and you will take the rate as the standard rate.
Hmm.
Okay. Understand, master budget is standard quantity into standard rate.
Okay.
And flexed budget is actual quantity. You flex the budget to the actual quantity, but you take the standard rate into picture. Are you
Okay.
with me?
Yeah.
Okay, fine. Now you have to find out the standard rate. Standard rate for material is $12.
12, yeah.
Okay. Standard rate for labor
For
is
labor,
$25.
25.
Can you give me the standard rate for sales?
I have to do 250,000 divided by 1120
Why 1120?
because that's the actual quantity.
Darling, I first want the standard rate.
Oh, then you have to divide that by 1,000.
Yeah. Standard rate I
Huh.
want. This is the total that is given, right? To get the
Hmm.
standard rate, I will have to find out by dividing with the standard quantity. So the standard rate is how much? 250.
Yeah.
Okay. For direct material, what is the standard rate?
12.
Per kilo.
Yeah.
For direct labor, what is the standard rate?
25.
Per labor hour.
Hmm.
Fixed overheads. Standard
No,
rate.
so fixed overheads का standard rate के लिए we have to do the Absorption na OAR
24,000, no, 24,000 is
divided by 1000.
divided by 1,000. So fixed
Huh.
overheads, your standard rate is 24.
Yeah.
Okay. Now let's prepare uh, our this.
That's
The
budget.
direct material is rupees 12 per kilo. But let me find out the standard rate per unit.
Okay.
What
So
will be the standard
66
rate per unit?
$6.
$60.
Sorry, 60, yeah.
That means we have been given per kilo. So that they are using more kgs to produce one unit, right?
Yeah.
And direct labor standard rate 100,000 for 1,000 units. So give me the standard rate for direct labor.
100.
100. Very good. So now
Yeah.
you have found out the standard rate per unit. Are you with me?
Yup.
I have to flex the budget, taking the standard rate but multiply it with the actual quantity.
Actual quantity. Okay.
Sales. So this flex budget will be for how many units? It will be for
1120.
1120 units. So come on, sales. Direct material. Sales minus direct material minus direct labor minus fixed overhead. So sales minus direct material, direct labor and fixed
And
overhead
fixed overheads.
would to give you what?
The profit.
Which profit?
Flexed profit.
Sorry,
The flexed profit, no?
budgeted profit as per flex budget.
Oh, okay.
Budgeted profit. Now you know when you're flexing the budget, everything will be for 1120 units.
Yeah.
So I will write that.
Hmm.
Everything will be for 1120 units. You
Hmm.
flex the budget for the actual quantity. Yes?
Yeah.
So actual quantity into standard rate. What is the standard rate? Come on, sales.
250 into 1120.
Now just give me the standard rate. Direct material, standard rate 60.
60.
Direct labor, standard rate 100. If you get
Yep.
confused, you can put the dollar. Fixed overhead, standard rate 24.
24.
Okay. So when you multiply, your sales will be 280,000,
280,000.
67, 200. 1120 into 100. This is 112,000. This is 26,800. So your budgeted profit is 73,920.
Let's wait. I'm just still doing.
Okay, fine. I'll wait.
Hmm.
Now, over here, they have given you the actual results.
Okay.
When I talk about actual results, it is what? Actual
It's the
quantity.
actual quantity into actual rate.
Actual
Yeah.
quantity is how much?
1%. So what is the actual quantity? 1120.
Actual quantity is 1120 units, and this is your actual budget. So I
Hmm.
want the actual rate also.
Yeah.
To get the actual rate, what will I do?
Divide
Divide by,
the all this cost given.
divide this cost by how many units?
1120.
So divide by 1120 and give
Yeah.
me the actual rate.
Okay, I'm doing.
Other than fixed overhead, you will find the actual rate for everything.
Okay.
So this is 248.
Miss, if it's coming as 64.9, I'm making it 65.
You just do directly.
Okay.
Okay. So when this is coming in points, you should understand that this will not be needed. Okay.
Okay.
Are you with me now?
Yeah.
State what is meant by the term variance analysis. What is
Um,
variance? It is a difference
variance
between your budgeted amount and the
and the
actual.
actual amount.
Okay.
Yeah.
But you have to write for 2 marks.
Um,
First, write the first point.
the difference between the budgeted amount and the actual amount.
So, is the difference between budgeted amount and actual amount. And when you're doing variance analysis, you're actually trying to analyze. Okay. You're actually
Yeah.
trying to identify the difference and you're trying to explain the reason for the difference.
Hmm.
When you're doing variance analysis, you're trying to identify the reason for the difference,
Yeah.
identify where the difference has happened, where is the difference between your planned and actual, and the reason for
Yeah.
the difference.
So can I write it? This is basically where
Variance
actual performance is
analysis,
better than actual better performance.
various analysis is a method to identify the difference, that where the difference has happened, and explain the difference. Are you with me?
Yeah. And it,
Now, calculate the following. Okay, we will always follow this method, right? SR,
oh
AQ.
yeah, this. Huh.
SR is for the all the volumes.
Hmm.
Yeah,
Yeah, SR is for volume and AQ is for
all
all
the
the
price.
rates. Yeah.
Okay. So sales price variance.
So this will come. The this is price now. So the formula will be standard rate minus actual rate into actual quantity.
So it will be standard rate minus actual rate into actual quantity.
Actual quantity.
What is your standard rate?
1 second. Standard rate is 250.
What is your actual rate?
248.
That means you expected to sell in 250, but you
Yeah.
have sold in 248.
Yeah.
So this will definitely be adverse.
Huh.
This you have to analyze yourself, okay? Into
Adverse and what is the second one? Favorable.
yeah, into
Okay.
actual quantity is 1120.
1120.
So 2 into 1120, it is going to give you how much?
1 minute I'm doing.
$2240.
Yeah, 2240.
Yeah.
Hmm.
So this is your sales price variance.
Yeah.
Now sales volume variance.
So for volume, it's standard quantity minus actual quantity into standard rate.
How much quantity you expected to sell?
1000.
How much did you sell?
1120.
And what was the price that you expected to sell?
You expected to sell at 250, but you sold at 248.
Okay. Now let's determine adverse or favorable. You
Yeah.
expected to sell 1000, but you sold 1120.
Yeah, so that's favorable.
That is favorable. I will write it. Okay.
Hmm.
Now 1000 minus 1120 is how much? Into 248.
Yeah, I'm doing. 29760. MS गलत है और ये सब.
Multiply by standard rate. What is the standard rate?
The standard rate is 250.
So why we take 248?
Oh,
Standard rate is 250.
hmm.
So it will become $30,000 favorable.
Yeah.
Please note, to write the favorable or adverse, you get 1 mark. Huh?
But this is only for 1 mark.
No, half mark will go away if you don't write.
Okay.
Okay. Now, when is direct material total variance? Okay. When we talk about
Yeah.
direct material total variance,
Total.
when we talk about the total variance, you can directly take your total.
Okay.
Okay. You can directly take your total amount. What is your actual? But you have to compare your flexed with actual.
Hmm.
Okay. Whenever there is total, you can directly take. If there is
Hmm.
price and volume, you will by forget the formula. But whenever there is total, you can directly take the total variance. Total as per flexed and actual. You will always compare flex with actual. Come on.
Okay. So you have to minus it.
Total variance I want. What was your total direct material cost as per flexed?
67,200. 67,200.
That means if you take your standard quantity into consideration, okay, your cost was 67,200
Yeah.
for your actual quantity. But actually, you still spent how much?
Actually, I spent 24,000.
How much
Oh
have you
no, you have to
actually
use
spent?
that expense. Sorry. Actually, I spent 25,600.
Darling, please read. What is that
Yeah.
material?
Oh, I'm reading fixed cost balances. 72,688.
72,688.
Hmm.
That means when you flex the budget for actual quantity
Yeah.
and you took the standard rate into consideration for same actual quantity, you expected that your material cost would be 67,200.
Yep.
But still, you ended up spending 72,688.
688.
It means you ended up spending more.
More. Yeah. So it's adverse.
Adverse. How much?
Um,
Dollar
5488.
488 adverse.
Yeah.
Okay. Now you can try this once more before we go ahead.
Then wait. Yeah. Same.
Now let's direct labor total variance. So I have already told you that whenever the word total comes, total, you will not use the formula. You will directly compare the flexed with actual. I am repeating again. Whenever the word total comes, you will directly compare flex with actual. Just drill it in your brain. When the total comes, okay, directly compare flexed with actual.
Okay.
Are you with me?
Yeah.
Come on. Direct labor total variance. So direct labor as per the flexed budget. This is the
Budget
actual
and
budget.
actual budget. Yeah.
This is the actual budget, and we have already calculated the flexed budget, right?
Yeah.
I'm just pasting it over here so that it becomes easier for you.
Hmm.
How will you do?
So the fixed overhead for the flexed budget is
Listen, darling, understand it's direct labor.
oh yeah, sorry, direct labor we have to do first. So direct labor for as per the flex budget is 112,000 and the actual
112,000.
yeah 112,000 and actual is 128,520.
Okay, now can you please explain me the interpretation of this?
Interpretation of this is that the direct labor as per the flex budget is 112,000
You
and
expected to spend 112,000 for the actual number of units.
yeah, but you spent 128,000, which is more. So first it's adverse.
Okay,
And it's adverse by 16,520.
very good. Okay,
Hmm.
now fixed overhead total variance.
So in this also you have to do, since total has come, you have to directly compare with flexed and actual.
So
So
fixed overhead as per flexed.
yeah. So the flexed budget ke as per it's 26,880
Hmm.
and actual budget mein it is 25,600.
Hmm.
So this is favorable because you spent less than you like wanted to, you're supposed to spend.
But don't forget to write the
Okay.
sign.
Yeah.
So it is favorable of $1280.
Yeah, it's favorable by $1.
Hmm. Okay, let's go ahead.
The direct.
Calculate two variances which combines to give direct material total variance. Now understand one thing, direct material total variance. It is made up of two things, right? Direct material variance is made up of what?
The volume and price.
And price,
Yeah.
right?
Yeah.
Direct material total variance is made up of
What?
direct material, volume is called usage, right?
Yeah.
For direct material. So it is made up of direct material usage variance
Hmm.
and it is made up of
Direct material price.
direct material price variance. That means there is a difference in your direct material variance. It is for how much? What was the direct material variance?
Miss, I can't hear you.
What was the direct material variance?
The direct material total variance is 1 second. 5,488.
5488.
Yeah, 5,488.
So there is a direct material total variance of direct 5488 and
Yeah.
the reason for this variance is either you have used more or less
Hmm.
or either you have paid more or less.
Yeah.
So they want the reason for, they want the two variances or they want the reason that has given you a total variance of $5488.
Yeah.
Okay. So it could be two things, direct material usage variance and direct material price variance.
Hmm.
Okay. Direct material usage variance. Come on, how do you calculate the usage variance?
For usage variance, you have to do standard quantity minus actual quantity into standard rate.
Hmm. And the price variance?
For price variance, you have to do standard rate minus actual rate into actual quantity.
Okay. So I will give you some time and I want you to try and figure out how will you calculate the usage variance, how will you calculate the price variance, and then we will work together. If
Okay,
you're
fine.
watching video, you can pause the video, work out, and then start.
Huh.
So basically, they want us to find out the reasons for the direct material total variance. The reason for direct material total variance is either you have used more or less, or you
Hmm.
have paid more or less for the kilogram.
Okay.
So that means you have to calculate the direct material usage variance.
Okay.
Okay. So usage variance is what? Standard quantity minus
Actual.
actual quantity
Yeah.
into the
Standard
standard
rate.
rate. Okay, fine. So now I have to find out the standard quantity, but for actual production. Everything will always be for what production?
Actual production. 1120 units.
Okay. Yeah, 1120 units. So let's talk about the standard quantity. Now we are talking about the kgs. Okay. Standard
Okay.
quantity, but for actual production. Okay. Let's
Hmm.
talk about the standard quantity that you expected to use per kg.
Yeah.
You have paid 60,000 for 1,000 units.
Yeah.
Okay. So that means your direct material cost per unit was $60.
Yeah.
Okay. Now they are saying that the direct material is for 1 kg, you are paying 12.
Yeah.
Okay. That means you have paid $60 per unit. So
Yeah.
how much is the kg that you expected to use per
Cross
kg that you
multiply. I have to cross multiply.
to cross multiply? That
Yeah.
means you expected to use
5
5,
kgs.
5 kg per unit.
Huh.
You expected to use 5 kg per unit. Okay. So your standard quantity of the material that you expected to use was 5 kg per unit.
Yep.
Now you have to take standard quantity for actual production.
Yeah, this I understood.
The standard quantity that you expected to use was 5 kg and actual production was 1120. That means your standard quantity for actual production is 5,600.
Yep. Okay.
Are you with me?
Yeah.
Your standard quantity for actual production is 5,600.
Hmm.
So you had to use 5,600 kgs.
Okay.
Okay. But now actually how many kgs you use, we have to see that. Okay. Actual quantity for actual production. Now you go to your actuals. You have spent 72,688 for 1120 units.
Yeah.
That means per unit your material cost is 64.9.
Hmm.
Okay, per unit material cost is 64.9.
Yeah.
Every kg is for 11.80. So
Again, then you have to cross multiply.
every kg is for 11.80 and you have spent 64.9. So how many kgs have you used per unit?
5.5.
So you have used 5.5 kg per unit.
Yeah.
Okay. Every kg you spent 11.80. That means you have used 5.5 kg per unit.
Hmm.
Now actual quantity for actual production. Standard quantity for actual production minus actual quantity for actual production. So your actual quantity is how much? Actually, you
5.5 kg.
for actual production.
1120.
So standard quantity minus actual quantity for actual production multiplied by standard rate. Okay,
Yeah.
are you with me? So
Yeah.
standard quantity for actual production is 5,600. Actual quantity for actual production is 6160. That means you expected to use 5,600. You had to use 5 kg per unit,
Yeah.
but you used 5.5 kg per unit. So it is favorable or adverse?
This is adverse. You use Jada.
Use zyada. So it will be adverse and into standard rate. So what was the standard rate per kg?
$12.
So the standard rate per kg was $12. So your direct material usage variance is 6720 adverse. So your direct material usage variance is how much? 6720 adverse. That means it's negative. Okay. First you do the usage variant 2-3 times and try to get the process of having it. So you say your direct material total variance is made up of direct material usage variance, and direct material usage variance is standard quantity for actual production. You will take the kgs in consideration, okay? Minus actual quantity for actual production, that is the kgs into consideration, and multiply by the standard rate, and the standard rate per kg was $12.
$12.
And we found out the standard material usage variance. Next is standard material price variance. So when I say standard material price variance, it would be standard price minus actual price into actual quantity. Are you with me?
Yeah.
But since it is material, the actual quantity will always be the kgs.
Okay.
Well, the actual quantity would always be what?
Kgs.
Kgs for actual production. Yeah?
Yeah.
Okay, fine. Direct material price variance. Direct material price variance is standard price for actual production minus actual price for actual production.
Yeah, so that's $12 minus 11.8.
Standard price is 12. Actual price is 11.80.
Yeah.
Okay, so the standard price is going to remain standard price, actual price is going to remain actual price. So
Yeah.
you don't need to again multiply for actual production, because here you're multiplying with the actual quantity for
kg.
actual production.
Hmm.
Actual quantity for actual production you have found out here. You have actually used
0.
5.5 kgs. Okay, actual kgs, actual quantity.
So,
Actual quantity, actual production. Yes.
yeah.
So you will multiply with 6160.
1232.
Okay. Now 1232. Now you tell me it is adverse or favorable.
It is adverse because you were supposed to sell it. No, no,
Yes,
it's favorable, huh?
you were supposed to spend $12.
Yeah, but you spent 11.80, so it's favorable. Now.
It is $124 1232 favorable.
Yeah.
So it is $1232 favorable. So direct material price variance is $1232 favorable.
Yeah.
So direct material total variance. Check total variance. One is adverse, one is favorable. So it will come to 5488.
Okay. You have to minus the adverse.
Yeah. So in overall, it is an adverse variance. Overall, it is an adverse variance.
Yeah.
Okay. Overall, it is an adverse variance, but you have paid less price to your suppliers.
Okay.
Now understand the consequences of this. You have used more quantity.
Mhm.
You have paid less because the price variance is favorable, right?
Yeah.
That means you have purchased cheaper quantity of, you have paid cheaper price.
Hmm.
So can you give more interpretation?
So that's good only. You've paid cheaper price, but you used quantity more, so you get that for cheaper also.
Darling, because you used cheaper price, because you paid less, maybe the quality of the material
Yeah,
was,
the quality of the material can go bad because come
was
mein
bad. And because the quality of material was bad, there was more wastage.
yeah.
If there was more wastage, you used more.
Hmm.
So you saved less, but you ended up wasting more.
Yeah.
Okay, so this is bad. Your overall total variance is adverse.
Um,
So because you purchased cheaper quality of raw material, you have ended up using more quantity, you have ended up wasting more, and the usage variance became adverse.
okay.
So how will you rectify this?
Rectify.
You purchase better material.
Oh yeah, you can purchase better material which will improve the quality.
Yeah, you purchase better material that would improve the quality. Are you with me?
Yeah.
Okay, fine. I'll go ahead. Okay.
Hmm.
Now read this question.
Explain the likely causes of the variances calculated in question DI.
This is done, na? D. Calculate the two variances.
There's another one uske niche which says explain the likely causes of the variances calculated in question DI.
Okay, so explain me. This is what explanation we did, right?
The right now, right? The quality one.
Yeah, yeah. So we have used more quantity.
Yeah.
Okay, we have used more quantity of the raw direct material, of the raw material.
Hmm.
It means that the quality of the material was bad,
Yeah.
or maybe your laborers were inefficient and they ended up wasting more.
Oh, okay. 1 minute.
However, the price variance is positive. That means you have spent less amount to purchase the raw material, giving a favorable price variance. But the overall variance is negative. That means you should switch to better suppliers. Huh? Price variance is negative. So
Yeah.
price per kilo is reduced, maybe due to a decrease in market price or trade discount for larger, or maybe we shifted to a cheaper supplier.
Okay.
And the usage variance is adverse.
Yeah.
Means more materials are used because of lower quality or inefficient use by laborers. Let's say.
In July, Y Limited had adopted a new strategy to increase sales by reducing the selling price.
So they wanted a new strategy wherein they could increase the sales.
Yeah.
Increase the sales quantity and reduce the selling price.
Huh.
Okay.
Advised the directors of Y Limited whether or not the company should continue the strategy in the long run. Justify your answer.
Okay, listen to me. Your initial selling price was 250.
Hmm.
Your new selling price was 248.
Yeah.
Yeah. You reduce the selling price to $2
Hmm.
and you manage to increase the sales.
Yeah.
Increase the sales to how much?
120 more units.
120 units. So reducing the sales, reducing the price can definitely increase the sales.
Yeah.
As we can see evidently in the month of July.
July में.
When I reduced to $2, it is for 5 marks. Okay, just keep the marks in consideration.
Okay.
When I reduced $2, 120 more units were sold. Yeah, are you there?
Yeah, yeah.
So when I reduce $2, I can evidently see that I expected to sell 1,000, but I ended up selling 1,120 units.
Hmm.
So if I am reducing the price, the customers are increasing. Okay, so customers can be increased, but you should ensure that reducing the selling price does not affect the quality of the product.
Quality of the product. Yeah.
Or this is things in favor of reducing the selling price.
Hmm.
Now, things against reducing the selling price. If I reduce the selling price, first my profit is reducing. I,
Yeah.
so if the profit is reducing, so there is no financial gain
Yeah.
because even if I am selling more, I will end up spending more in the direct material. I will end up spending more for direct labor and I will end up spending more for fixed overheads.
Yeah, because that price is not changing.
Because that is going to happen if the
Yeah.
more units are sold, more direct material, more direct labor, more fixed overheads, because fixed overheads are absorbed on the basis of direct labor. So the
Hmm.
first thing that is against reducing the selling price is that there is no financial gain.
Yeah.
Also, if I'm reducing the selling price, more number of units are sold. That means more number of units have to be produced.
Yeah.
But you should have the capacity to produce, right?
Exactly. Yeah.
The company may not have enough capacity to cope with increased production.
Okay.
Possible?
Yeah, possible.
Okay. Another thing against reducing selling prices, because you're reducing the selling price, you will try to reduce your material cost, you will try to reduce your labor cost.
Okay.
And if you are reducing the material cost and trying to switch to cheaper material, your
Quality
quality
may
of
be
the
going
product may
bad.
be compromised. So we can definitely reduce the selling price. You have to advise. So advice gives you 1 mark.
You can reduce, but you have to ensure that the quality is good.
And up to the point where there is good financial gain.
Yeah. Okay.
Okay. So with this, we complete the Feb March 22 paper 32 question for standard costing.